one is cloud computing. The cloud, I think, is fundamentally changing the way we organize information and data. And this is quite hopefully transformative. Second, following from that, big data. I think as one of us said, all companies are technology companies. They just do different activities. And data is the critical competitive advantage. So mastery of data and big data is the key area. It helps regulation, it helps effective risk management, it helps create business opportunities. Third is artificial intelligence and learning algorithms. And fourth, distributed ledger technology, which Blythe spoke about. And there too, there's a mixture of hype and reality. Some use cases are probably not going to get anywhere. Other use cases, I think, will go far. And I think we've got to see central bank digital currencies in that context. We're not doing this because we are threatened and want to find a new way of life. We're doing, again, it goes back to the tech use cases. So we issued a central bank digital currency earlier this year. And not because we wanted to CBDC for its own sake, but because we wanted to solve the problem of cross-border interbank payments. Hugely expensive, inefficient. Christine, if I want to send you money, please, bank charges are incredible. And this is the 21st century. We shouldn't be doing business this way. Other sectors have moved ahead. A telephone call is free today. So this is a difficult problem to solve because there's a network of correspondent banks. There's a settlement risk because settlement is not instantaneous, even if payment is instantaneous. And so we conducted an experiment where we wanted to see, by using digital currency and taking the central bank out of the picture, whether in a distributed ledger system among the banks, they can actually pay, clear, and settle. And we proved that it can work within the domestic setting. And now we're looking at the next phase, where you want to ensure that the same principle of what Blythe referred to earlier as there is transparency of transaction, but confidentiality of identity. And preserve that in a cross-border setting with another central bank sitting on the other side also issuing digital currency, which is used as a token, and then you can have a payment. The Holy Grail is 24/7 real-time operations with instant settlement. If you can achieve that, the savings that banks can make with collateral and capital that's set aside, huge. And for the man industry, there are about 10 million migrant workers in ASEAN, in Southeast Asia, where I come from. Their meager earnings that they make, they need to send back to their village. It's a shame that the financial system doesn't serve them well. And then they resort to other means, which has its own sets of risks. And if we can solve this problem and offer them a way in which money can be sent, that would be tremendous.
So how would you do that? Would you go to Blythe and say, I need your technology and I want to be able to have control, and I don't want you, provider of that digital platform, to have access to the data because there's privacy issues. Could you do that? Could you too? I'm not suggesting that you cut it all now.
But Blythe's on our advisory panel, by the way, so we do consult international experts on how we can do these things better. The way we've done it, we've got a consortium of banks. We don't see this as a contest between the fintechs and the banks. We see them working collaboratively on this. So with a consortium of banks, co-create a solution, agree on the rules of the game, how we're going to achieve privacy and confidentiality, and the distributed ledger does that by design. And you've just got to ensure that. And then have agreement of how to proceed.
Like, what do you think?
Well, maybe I'd like to take one step back and just address the broad question you raised about regulation and does this whole phenomenon need regulation? And obviously regulation is a huge concept, and there's many different areas and outcomes that one needs to regulate for. But I think if you take a basic approach which says, to use Ravi's expression, let's look at the outcomes and think about outcomes-based or perhaps a principles-based regulatory framework, it becomes pretty easy to identify situations in which fintech approaches to financial activity are resulting in blatant regulatory arbitrage opportunities. Now, there's two kinds of those. There's the outcome where there's the kind where the outcome is socially undesirable, and there's the kind where the outcome is desirable. And if you are in the situation of the former, then you need to regulate fintech activity to shut down the arbitrage. And if the outcome is the latter, then you need to lighten up on whatever it is that's preventing the financial services sector from essentially doing the same thing. If you take that approach and you sift through all of the numerous different activities that are underway here, which range from micropayments to international remittances to large dollar value payments to settlement to clearing to identity management, transaction processing, you'll come to a very different answer on a case-by-case, outcome-by-outcome basis. And I think clearly the correct answer is you should regulate outcomes as a function of their impact on society, whether that's consumer protection, whether it's financial stability, and so on. If you want to run a national market infrastructure for your stock market, for example, on a distributed ledger technology as opposed to a conventional one, you better have good answers to the voluminous questions that regulators are armed with today around how to operate a financial market infrastructure that includes a ton of questions around resiliency, reversibility, auditability, recoverability, you name it, high availability, equal access. And if your solution using a distributed ledger or blockchain-based system doesn't meet those standards, it should not be permitted. In that case, the regulations exist. Because you can't just start running a national market infrastructure and expect not to be regulated. That's a body of regulations. In other cases, the activities are new and or are being conducted under a different rubric or a different umbrella, and the regulation doesn't just quite fit. So the answer is that a lot of work needs doing here, and that an extensive degree of interaction between not just the disruptors and the innovators and the regulators, but also the incumbents who share in this, because the incumbents themselves need to learn how to disrupt their own businesses, but equally should not be held back from offering essentially the same services that others who are not regulated coming into the same space are suddenly able to do. So this is a complex, long-term, multi-party interaction that I think is already going on and needs to continue to go on, and it needs to be fact-based, not emotionally driven, and it definitely needs to not be about picking winners and losers. It needs to be outcomes-based. Who benefits here, and is that desirable or not? And that
it's interesting that both of you have mentioned the outcome. And my sense, at least historically, and I'll turn to you first because you know the history a lot better than all of us, is that typically the oversight, the regulations, the role of the supervisors has had to do with the entity, the activity. Do you qualify as a bank? Do you qualify as a trader? Do you qualify as an exchange? Whereas it seems that you're talking outcome, you're talking activity, you're not talking about entities or roles or boxes in which you are.
The margins are blurred now.
Yeah. So payments, for instance,
yeah,
it's different. There's funds